Welcome to episode 18 of Kontrarian Korner. I'm Ben Kelleran. Today we have a very special guest coming on to talk with us about a couple companies that I own, and it's not going to be investing advice. It's obviously your guys' own money, so do with it what you will. But I think it'll be a couple interesting situations to take a look at. So, Judd, thanks for coming on.
Thanks for having me, and not to make the lawyers that happy, but my simple disclaimer: everything we say is for discussion purposes only. Nothing is investment advice. Some or all the securities we discuss may or may not be suitable for you. Please talk to an investment advisor before making any investment decision. Investing in the market contains a series of risks, including and especially the risk of loss. That is my disclaimer. And now, should I tell a little bit about what I do?
Yeah.
Perfect. All right. So I'm a Minnesota guy. I went to school at Indiana. I made my way to Wall Street. I was a banker at Lehman, a junior bank. I worked for bankers, making PowerPoint and whatnot. I left a little bit before the end of the 2-year analyst program to join my first of two big distressed credit funds. Did that for about 9 years. Then I went to a pod shop, and my team spun out, launched a hedge fund at Neuberger Berman. I believe they're still there. That whole experience was 6-7 years. And since COVID, I've been running Lake Cornelia Research Management. Lake Cornelia is just the lake by my dad's office in my hometown. I find it funny because most people on the coast think Minnesota and think corn, and some of them actually believe there's a lake of corn, but be that as it may. I provide advisory to about 10 family offices and hedge funds, people looking for outsourced idea generation, or just they want to know what I'm doing. So about 2/3 of the clients are people who hire me as like basically an outsourced senior research analyst, most maybe with soft dollars, and then about 1/3 are allocators. The hedge fund model is weird now. We can talk about this too. Like I had one that my aha moment was an allocator told me, he's like, 20 cents on the dollar of my hedge fund allocation goes to funds, 80 cents is back booking. And he's like, with you, it's great. You just tell me what you're doing and I don't have to invest in your fund. I don't know if that's a compliment or an insult, but be that as it may, happy to talk to people. Always looking to do that. But with that little advertisement out of the way, let's jump right in on this fun. It's 9/11 Wednesday. I was a sophomore in college in Indiana when the tragic events occurred. And class was not canceled. My astronomy professor made sure that we were there. And he left the final exam on the internet from the year before and changed the order of the questions. Very, very small. And I was done in 10 minutes. And
I was thinking kindergarten, either kindergarten or first grade. So definitely.
That's why you still have a full head of hair.
Yeah. Right. So I think it'd be good to start off with Sable, because I think with some of the recent news on their settlement with Santa Barbara County, I think the risk reward from here looks pretty good. Like the upside obviously had a nice pop last week, but I think a lot of the risk has been taken out after the settlement. So if you want to give us a 30,000 foot view of Sable, we can kind of go from there.
Sure. Let's just start at the highest level. This is one of the few things that should always be a SPAC. And it was SPAC'd by Jim Flores, the former CEO of not Pioneer. Oh God,
Plains.
He had a great exit at Plains. I'll say super seasoned energy, oil, and gas CEO. He touched this pipeline for Plains. Used to own the platform, and for people who don't know, this at one time was Exxon's best domestic United States oil asset. It was doing anywhere from 15 to 20 million barrels a year of production. And, just offshore Santa Barbara, these platforms have been there forever. You can see them very easily from your beautiful $20 million house, if you so have one. In 2015, the platforms are offshore. They're in federal waters. There is a pipeline, obviously, that takes the oil onto shore in Santa Barbara and to a processing facility. That pipeline and the processing facility are regulated also by California. There was a 4,000 barrel spill in 2015 because the pipeline's like 30, 40 years old. And 4,000 barrels, for people who don't know, is like nothing. The Exxon Valdez was 1 million barrels. Like 4,000 is nothing. The seepage just from the ground, under the seabed in Santa Barbara is probably I don't know, 50 to 100,000 barrels a year. So nothing, but it's California. And that's sort of the story. They shut down the pipeline. Exxon had to shut in the facility. It's also with oil at this point in time. This was during the energy bear market. Doesn't really make sense. This thing's 90% oil cut, very low cost. Lifting costs are, $15 a barrel. Sable thinks they can get down to 10, but it's basically just, pure margin. Right. And, Exxon didn't fight right out of the gate, or they did fight anyway. Long years of litigation went forward. California's strategy has been not just with Exxon, but with everybody. Chevron's leaving the state. Most of the oil guys in California are California only. So there's California Resources, which was spun off from Oxy over a decade ago. There's Berry Petroleum, which was independent, bought by Lynn, then sold, then separated off post the Lynn bankruptcy. But like, most guys are California only. The reason is California's regulatory strategy is to impose all of these onerous regulations that you have to agree to, and those regulations apply enterprise-wide. So if you're an international oil company like Exxon or Chevron, you're like, well, I can't really agree to all the stuff that California wants me to do, because the NPV of getting my California production back versus the negative NPV and what that's going to mean for my production in Guyana or wherever is like, it's such a big mismatch. It's tens of billions of negative NPV across my enterprise. So I got to get out. Jim Flores, the CEO of Sable, former Plains guy, makes a deal with Exxon to form this SPAC. And the deal was, listen, guys, I can agree to more stuff than you can agree to. There's ongoing litigation. The county is blocking a bunch of stuff. I don't get why the county is supposed to be involved. This should be State Lands Commission and the Fish and Wildlife Board. But like, I can agree to more than you can. Exxon's never going to get this over the finish line. I will give me 2 years, and I'll give you take back paper, and that way you'll get some value. And Exxon says, here you go. So they do this SPAC, and Jim's got the deal locked up. He's got take back paper from Exxon to partially finance this thing. It was $600 million of take back paper at the time, 10% PIK. It's now $900 million. Restart's going to cost, call it $500 million. And we have this SPAC. And it came out, I was like, this is interesting, but like, California regulation really hard. And December 2023 at the State Land Commission, there was a ruling that was basically bludgeoning the county. That was, we agree with this restart plan. And the county about 2 years ago, just to rewind the tape, had blocked the restart plan. They wanted to put in these things called check valves. Check valves are just these two-way valves that if there's a leak, basically they stop the flow and they prevent the leak. The technology for a check valve, I believe we had it in 1850, and it is state of the art, the best available control technology, and it's installed all over California. And the county was inartfully like, okay, we're just going to prevent you from installing these on some visual impairment sightline stuff. So a lot of messy stuff. But anyway, the State Land Commission in December 2023, and Sable stock had traded from 10 at the SPAC price to, I don't know, $2-3. The warrants were 25 cents. State Land Commission comes out and gives a very favorable ruling, basically signaling they're going to approve this thing. The warrants shoot up to $1. Sable stock shoots up to $5. And the SPAC hadn't, or maybe I'm describing the stock. The warrants were at 50 cents, shot up to $1. The SPAC hadn't closed yet. And I start looking at it. Somebody poked me who's pretty smart I used to work with. He's like, take a look at this. He goes, I think the deal can close, the SPAC transaction. And it ended up closing in April or May. He's like, the State Lands Commission basically allows this thing to happen. So they closed the SPAC deal April, May. They raise a huge pipe. I mean, at this point, I think the SPAC originally was 30 million shares or 29 million shares. There's about 15 million public warrants. They had to extend the life of the SPAC twice. And in each extension, the SPACs of 2 years, people could redeem and get trust value. So by the time you did the deal, there were only 6 million shares left in the SPAC. So they do this pipe for another, I believe, 59 million shares. So you have 65 million shares. Plus the warrants, there's 14.5 million public warrants, and there's another 10 million private warrants. Deal closes. And now the CEO has got to basically get to approval. And the big thing that came out this summer that really started the momentum was the state fire marshal. So when the county rejected the check valves, Sable went back to the fire marshal and said, here's my alternative plan. Fire marshal looks at this for 2 years, comes out this summer and says, I see your plan. I hear your plan, ... I don't care. I originally approved check valves. Check valves are best available technology, ... They are everywhere in the state. And I don't understand why the county is not approving them, period. And at that point, I was like, this is game, set, match. The reason I thought it's game, set, match is in parallel, Exxon had filed a multi-billion-dollar takings claim lawsuit against Santa Barbara County years ago that was inherited by Sable. And the takings claim argument effectively is you're unreasonably withholding my approval. And in so you are taking my property unjustly. Once you had the fire marshal basically slap the county this summer and say, it's everywhere, the check valves, they want check valves, that's the plan. You can't say no to that. Now the takings claim litigation is really energized because now you can go, if the county doesn't roll over and just approve these things, now you can go to the Ninth Circuit Court of Appeals, which is the most liberal court in the country, but this is like a per se case. You could be like, I'm suing the county for $10 billion. That's my estimate. That's my PV10. And I have a great per se case. Here's the fire marshal who is the presumptive regulator in the state. The county is superseding California law. They can't, like, the fire marshal says this is best available control technology. The county has no standing to do this. The pipelines are below ground and all this stuff. And Sable was probably going to make the county put up a $500 to $1 billion bond to litigate. And at that point, the county, I was like, this is the come to Jesus moment. They fought it for 2 years since they blocked it. Now the general counsel of the county can go to the 5 people on the board and say, tell all your rich people, like, the county's got a $1.5 billion budget. If we have to put up a $500 million bond, even if we win, this county's going bankrupt, and they're going to win in the end. And then they're going to own, like, not really own the county, but like, this is like some like Mad Max movie, but like it would be bad. So what made the stock finally rip? So it ripped a little bit. There was a little debate on Twitter. I was like, when the fire marshal came out this summer, I was like, this is a done deal, man. There's all this litigation about best available control technology and maximum available control technology going back 50, 60 years. I mean, I've been an energy guy my whole career. I'm like, the fire marshal said it's backed. That's it. That's the case. The Ninth Circuit and if it goes to the Supreme Court, they're going to say the fire marshal is exclusive jurisdiction to determine backed. And it's everywhere else. Like, that's the other thing. It's not like a unique or novel backed determination. It's like, it's literally everywhere. So the county, and what made this thing rip from, once the SPAC closed in April, stock had, on every minor successive thing had sort of rallied up to about 15, 16. This happens. There's a big short interest. The stock rips up to 24. And it's come back to about $20.50. Some of that, I would venture to say, especially over the last 2 weeks, is oil falling off the proverbial cliff.
I think Sable is probably the only thing that's been green in the energy space over the last month. So
so now we can sort of indulge ourselves in the upside case. When they put out the SPAC deck, they did, all their numbers are based on a 10 million per year production. If you look at the historical production of this thing going back to the 90s, they've usually done 15 to 20 million barrels a year. And the big upside that management keeps talking about is like, man, these electronic submersible pumps, ESPs, which are like, 10, 15-year-old production enhancing things. Only 2 of the 90 wells at Sable have these ESPs. So this is just formulaic. We install these ESPs, like, more oil is going to flow. On top of it, like, this was a cash cow asset from 2015. Oil and gas infrastructure, like oil field services, gotten a lot better since 2015. Like, there's a lot more we can do here. Basically, there's a lot more oil, and we're super confident the production is going to be a lot more than 10. It's probably going to be 20 to 30. And at a $10 lifting cost, a little bit of G&A, you're like, wow, okay. And $70 oil. So, and this is Brent, by the way, because you're in California, so you get Brent pricing, not WTI. Sometimes you get a premium to Brent. $70 oil. This thing does 400 million of EBITDA, less 30 million bucks of maintenance capex. So call it 370. And let's just do the math. All right. So they're going to exercise all the warrants, and that's going to be the last funding for the deal, or force the warrant guys to exercise. So you're going to have about 85 million shares. We're trading at 20. So call that 1.7 billion. You've got debt of, call it another billion, and so forth. So you're paying, 2.7 billion, and you're going to have, low case at no production increase, you're going to have 400 million bucks of EBITDA at $70 oil, 500 at 80 Brent. And then you start thinking about the production increase, and you're like, this could be 750 to $1 billion of EBITDA. Round numbers, EBITDA, capex basically less capex basically the same. You could have $1 billion of cash flow on this coming out of this thing, and you're paying $3 billion for it. And the duration, they put out a $10 billion NPV or PV10 on this thing, massive reserve life. They are supremely confident that the amount of reserves there is completely understated. This probably runs for 50 or 60 years. So where could this trade? This could trade like BP Prudhoe Bay is where this could trade. This could trade to an 8% yield. So a 12, 13 times multiple, just huge numbers. It's not difficult to really paint a story of north of $100 on this thing. You've got a control shareholder with the CEO. I mean, he's got, if you include all of his warrants and everything like that, he's got about 20, 25 million shares. He has said he is going to pay down the debt and then just literally pay out all the free cash flow. So I think to your point, I think it's a much easier trade for the masses, if you will, at this point. What are we waiting for? We're waiting for the final approval from the State Lands Commission, the final certificate of operation from the fire marshal, which they should get. They're installing it. The check valves might be installed already. They said it was going to take 2 weeks, and we're long past that. And then Fish and Wildlife has a say in this. I don't think they have a big say. They can get sued too. And I think now with the county and the fire marshal already saying this is done, it's incrementally harder for anybody else, especially the Fish and Wildlife, to say no. Going back to the State Lands Commission, I've had some questions about that because they have to approve the operator change from Exxon to Sable. If they say no to the operator change, this still goes forward. Per the PSA, Exxon is required to remain the operator until the transfer is approved, even after production. So that's kind of a nice nuance. There was part of the short interest in this thing, just to do an aside, was that people were misreading the deal. And Exxon the deal says you have 2 years to get to production. Otherwise, this reverts back to Exxon. And what people missed is that was put in there to put a time pressure on the regulators. For the reasons I've stated in terms of why Exxon had to sell this thing in the first place, which is they can't agree to all the regulations that California wants, they're never taking this back, ever. Their choices are shut it down or try to get some value from a guy like Sable to restart this thing. So 2 years from now, if for some reason somebody at the 25th hour, despite a 7-year litigation that seems to be ending, if somebody's holding back with something, which, all the green Birkenstock people, environmental lawyers spoke at the last State Land Commission hearing, and their argument, it was like an emperor has no clothes. They were going in there. They're like, look, we know what all the case law and the precedent says. We know you have no jurisdiction to deny this, but think of the state and think of the spotted owls. They seem quite genuine, not like they're lying. And if they had something in their back pocket, I think they would have already long played the card. So the company reiterated production start likely Q4. I think from a taxing standpoint, they have to wait 20 days for the stock to trade average over $18 a share to call the warrants. Once they call the warrants, you have 30 days to exercise. That'll bring in 14.5 million times 1150 exercise, just under it's like 170, 180 million bucks. And that sort of gets you to 85 million shares outstanding. They'll have enough. So I think we're now just waiting for the official press release of where we're starting, which I believe the final check is the state fire marshal once the valves are installed, giving a certificate of operation.
Yeah, so that's a pretty detailed look at it. As far as the kind of path to production, what it looks like as far as production ramping, what does that timeline look like, you think?
It's going to be a full year until you get to full production. The first 3 months, you've got to like refill up all the tanks. I think they're going to go well by well. I mean, there's certainly execution risk. Like if you were freaked out taking this to the committee, I think you'd be like, all right, the thing's been sealed since 2015. If you make any screw up of any kind, they're going to shut you down. So I think that like the moment that you're going to get a real all clear, like this thing's cash flowing and like there's no execution risk, you're probably 12 months away from that. So I think from a cadence standpoint, I think the stock re-rates again once you get like the official we're starting. And then you're going to have some mini milestones with like, okay, we're flowing good, blah, blah, blah. This is fine. And then, the first dividend's going to be sort of important. The other, parallel thing is within 6 months of starting production, you're required to take out Exxon and their PIK paper. And that's a pretty big catalyst too, because I presume they'll refinance this thing at, 7% maybe. I mean, they'll just get a big term loan. And that'll be a nice little data point as well.
Yeah, so I think, like you said, the next 3 to 4 months are going to be interesting to watch. As far as you'd mentioned the dividends, once kind of all those boxes are ticked, what do you think that looks like as far as kind of capital returns? I know I don't want to get too far ahead of myself as far as counting eggs before they hatch or counting chickens before they hatch, but do you think they just dividend out, or you think there's going to be?
Yeah, I think they paid out debt. I mean, they have a little bit of capex they got to spend on the ESPs, and they put that in the last deck. But I think you're looking at medium term, $4 to $6 per share of dividends, and eventually this thing could pay out $10.
Yeah, no buybacks though.
I mean, if the stocks, it just depends on the stock. You have complete alignment with the CEO, right? This is going to be.
Well, he owns 25% of the company. Then you have insiders and institutions that own another 40% or something like that.
Yeah, if the thing's cash flowing, say he refis the debt, at 8 points, and he's like, okay, my stock's $30 and I'm about to cash flow. I'm sure he's going to buy back all the stock he can buy back.
Yeah.
I think the hope is that you don't buy back stock, because that means that it's trading just on a yield, like an 8-9% yield. But I mean, these are all first world problems. I mean, I think the stupid math in my mind is we're sitting here 2025 right now. Okay. NAV, if they do everything they've said, is somewhere between 75 and 125. And that'll go up when you get the next reserve report at the end of the year. And then next year it'll go up again, because the reserve report's just going to keep growing. There might be 1 TCF or 1 T of gas there. And natural gas in California is actually worth something. It's the same thing with the oil, which is you're on this little island and, flows can't come in. So, I think once you get the press release that says we're starting production or we're good to go, I think this thing's 35 by 45. And then you sort of drift into the mid 50s. That's my guess and my hope. So, maybe 30. Maybe oil goes to 50. I don't know.
Yeah, I think it's been a rough ride for oil, but I look forward a couple of years, and I have a hard time seeing oil sticking around the $60 a barrel range, but we'll have to wait and see on that. So
this is awesome. If you're not an environmentalist, this is actually awesome for California. It's about 15 or 20% of California oil demand.
Yeah, that's what I heard. I think they, before they shut off, I think it's somewhere between, I thought I saw 15, but I could be wrong on that. But
I have 15 in my head. It's 15. I mean, if they really ramp this thing, it's 15 to 20, which is awesome. Because California is supplied, those big boats come all the way across the ocean. You're getting Persian Gulf through Asia across the Pacific. You're getting some Asian barrels. There's big Aframax trade, obviously, out of Canada because the port's too shallow, but whatever.
last thing I kind of was looking through some of the stuff you were talking about Sable with was some of the carbon capture stuff. So I think that'd be something interesting to touch on before we kind of wrap up with Sable and move on to Navios.
So the carbon cap, they have a ton of land, and they've talked about carbon capture. They've also talked about data center. They have a small power plant. They're going to need to get, I believe, a new air permit to have a bigger power plant. The power plant would just run off the gas, and that would feed sort of the data center, either in the land that they have, or you have a power plant specifically dedicated to data center that's like in your footprint, and then you do the data centers more inland. So that's one thing, and that demand is massive. And then if you marry that with carbon capture, or you just do the carbon capture as it is, I've heard that's north of $1 billion, of value too, somewhere between $1 billion and $2 billion. That also might be, the fake trade, if you will, where you tell regulators like, look, I have to give you a win. So I'll agree to spend the money on carbon capture if you force me to and give me the approval. And the regulator gets to say, they have to do carbon capture. And Sable says, we are required and authorized to do carbon capture. And we're really excited. We're going to make a ton of money. So the carbon capture data center, that whole thing, that might be, look, if it's, let's call it $1.5 billion, 85 million shares. Like that might cover the entire stock price. Yeah. So I think, management's pretty bullish on it. There's certainly some milestones there, but like, I think the thing that brings that forward the most is if you get, again, this like quote unquote grand bargain with the regulators at the end of the day, where they agree and they think they're winning and you think you're winning, and everybody, and we're carbon capturing in Santa Barbara, whatever. That'd be great.
Yeah. So I think it's safe to say, my opinion is that fair value is not in the 20s. So we'll have to kind of wait and see how that plays out. But
it's buyable now. And like, I think that's the big thing. Like I was prospecting, you buy this thing. I got my first trade in the warrants was 1. And I've been adding to the warrants, lately, which is a little weird. You buy the warrants at 1 and then you add to the warrants at like 11. But the de-risking, because the big fear people had is that the county could like take this on indefinitely. And as much as I talk to people about the takings claim litigation, like it's just like, okay, you're going to sue in the 9th district, takings claim against the county. It's California. But like, even if you win, you lose. Like it's just literally, it was too hard. And I think now, I mean, obviously there's a long explanation. It's still not the easiest trade to pitch. I think most PMs are going to look at this and say, California oil, no, thank you. But I think incrementally you're getting certainly like litigious, sharp, deep research people. I think it's much like an analyst can pitch this to his PM credibly now post the settlement, where I think before it was like you'd be laughed out of the room and you'd worry about your own credibility and your career reputation, where I think now you can say, look, it's moved a lot, but like it's still disgustingly, like we can still 4 or 5x. And that should assuage sort of, your fears on binary risk.
Yeah. Especially if you think oil's going higher in the next several years, which
and if it's not, it's a good oil bet. And like, look, for the Russell guys, it gets really interesting. This is in the Russell, and it's like not an immaterial size. It's about an average. I think it's about in the 50th percentile. The float's pretty tight, but like if you're like, Russell benchmark, you think about like your oil exposure. You don't want to take a lot of oil exposure if you're Russell benchmark. It's 10% of the index. Most people hate, most of these guys are growth oriented if you're a Russell manager. And it's like, hey, you get to take 50 basis points of your funds. So you're not risking much in the sector you hate. And this could return way more than, taking a big energy allocation. I just think the Russell thing incrementally is going to be really positive. In terms of flow, like there's a lot of ways, and I think there's a lot of buyers that are going to step up. If not now, certainly on the next approval. That's why I think you're going to get a step function, which is it's on people's radar. And if not for the price of oil collapsing, it's green today. It's green. When does that happen?
Yeah, someone tell
someone start another.
Someone tell the offshore names.
Yeah.
But yeah, before I get to the offshore stuff, I think it'd be interesting to take a look at Navios. I know you've done a couple of podcasts on that. Your memo is a really good deep dive. The thing that kind of caught my eye was the insider ownership and the incentive distribution rights, where I was looking at it as like, okay, I need to take a closer look because I'm admittedly a tourist and kind of the whole shipping sector. And I think it just looked cheap enough and compelling enough to take a shot at it. So if you want to do the quick overview of Navios, I think that'd be a good place to start.
Yeah, they've got, oh God, I think 150, 175 ships. I should know that. It's basically a third, dry bulk, containers, and tankers. And the backstory on Navios is it used to be 5 or 6 public entities. And a lot of people went bankrupt during the energy bust post 2014. The CEO is Angeliki. She's like the best Greek woman shipping. She's a very intense person, as you would expect. She basically had a choice of like, how do I salvage my quote unquote empire? And the decision she came to is starting in, I think about 2019 or maybe 2020, she started merging all of her entities. And where she ended up was with NMM being the last entity. It's a GP LP structure. It is a 1099, not a K1. There's a GP interest, and I know it says LP. I told them they should change the name to Navios 1099.
Yeah, I've gotten a couple questions like, hey, is this a partnership? Does this take a K1?
Yeah.
I'm like, no, it doesn't.
No, you get a K1. But so that all those things were finally effectuated. The last thing was the holdco that held the GP in this and the South American logistics business. She took that private. She owned 2/3 of that. She took that private in the end of 2023. And then you were left with just this entity, NMM, outstanding. And, it's got like a real market cap. Like there's 8-9 billion of total equity market cap in dry bulk. If you think about that, tankers is the biggest market cap. The third of this that's dry bulk. I mean, this is real. This is like $1.5 billion. It's like $1.5 billion market cap, which is kind of, it's 30 million shares. It's like a real size company. I was like, this is trading price to book. It's like below 50%. Price to NAV, like shipping values have really started increasing. I was like, this is 0.35 times NAV. Most things in shipping trade 0.8 to 1.1 times NAV. And I dug a little deeper, and it was like there was a lot of heartburn on all the moves that she made to merge the entities. People are really skeptical of Greeks. This is Delaware law, but litigated in the Marshall Islands, blah, blah, blah. Like, whatever. The stock really started working this year. And in March, she bought, 300,000-400,000 shares. She's already the biggest shareholder. She owns over 5 million shares. And she bought 300,000, and it was like, okay, the stock re-rated immediately from 30 to, which it had been between 20 and 30 for 2+ years, and went immediately to mid 40s. Then on the most recent earnings call, they started the buyback. And that's been the other knock on this thing. The dividend's 5 cents a quarter, 20 cents a year. It's like nothing. They have this big new build program, and she started buying back stock. So you have all the inklings. So we put out a memo in June, and we really focused on the IDRs and sort of the cheapness to NAV. And we made really the story like, okay, you're making a really cheap Capesize bet. Yes, she's got containers and the long-term contracted and product tankers, but like, Capes have really started to rip. She's got 35 of these, 10, 11-year-old Capes. She's got a bunch of Kamsarmaxes too that are 7 years old. And like, wow, you do the math on the dry bulk fleet. If we get like a normal dry bulk bull cycle, that could be $1 billion of EBITDA on its own. All of a sudden, this thing that's doing 850 of EBITDA, with an enterprise value, 1.5 billion market cap, 2.2 billion of debt, so called 3.5. This thing could be doing, 1.5. You could be buying this thing for under 2 times EBITDA and, 0.4 times NAV. That was this summer. Post the Q2 earnings, where she started the buyback and announced more new buildings, we really took a step back and we put out an update memo. That was another, for us, we like writing books. The first memo was, I think, 50 pages. The update memo was another 50 pages. And we said, look, we thought about it. We went back through the quarter. It was great. The stock ripped on the quarter with the buyback, and it was a nice 10% beat. Or like, we were thinking about this totally wrong. The IDRs, and like her IDRs really kick in above distributions of about 25 per share. And again, the stock's 50. So if you get to the point where her GP's interest is in the money, like you're 2 times cash flow, which is crazy. And she announced more new builds, and the new builds are massively in the money. And so we had, like, in the first memo, we on purpose really downplayed the new build program because experience, most people hate new build, and rightly so. New build usually comes mid to late cycle. By the time the boats hit the water, there's a big order book, day rates come down, blah, 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 and you die. She's really leaning into new build when no one else is building, and her new build program is probably 30-40% in the money. On the Q2 call, we thought it was going to stop too, because we just assumed everybody else would catch on. Like these deals are just too insane. I mean, a third of her new build program, which is north of $2 billion, are 10 5,000 TEU container ships that she's got on like 5-6 year charters at, I think, about a 35-40% free cash flow yield. It's like, I mean, these things are like 40. I mean, it's crazy. She's buying these things new with contracts. We put this in the update memo. You model out the debt, and she's going to be into these things at like, 50. Like once the 5-year contracts roll, she's going to be into them at like a 50% discount to where current 5-year values are. Like, there's just no way she's like, it's just massively accretive. And so you think about the new build program and where ship values are going. You're like, I have a $50 stock. She's getting more of this new build that's like deeply in the money. No one else is building. And we wrote this big section about how the competitors are giving the game away. I think Scorpio is really the poster child for like what we would consider to be bad capital allocation, where they're selling their fleet. They're trading at 0.7 times NAV. They're liquidating their fleet to buy back stock. You never close the full NAV gap in our experience. So maybe you're giving up your entire fleet and all your future upside potentially at like still early in the cycle, and it just doesn't make sense to us. Where she's still sourcing new build, and albeit in product tankers too. She's doing a ton of these LR2 Aframaxes. Sure, also awesome deals. She's building them at 65 million. Resale value is 85 right now. The 10-year value is about 62. So it's like she's doing new build there at like, great 20-25% free cash flow yields, cheap to 10 years. Anyway, do all this and we're like, dude, NAV, like we thought it was like at least 150. Jeffries is 160. Either way, it's going to be north of 200 by the end of the year, or by the end of next year. Sorry.
End of 25. Yeah.
Yeah. And we're like, here's the math, guys. Like, she had 750 of EBITDA at the end of 2023. The new builds that she has announced that are financed, we're done. Like, they're coming. These are like top of the line new builds. And it's like a third product tank, 40% product tankers, a third containers. And there's some other stuff in there. Like, that's a $300 million contracted, 5-year contracted cash flow stream. So you're just going to have EBITDA formulaically. If day rates across the fleet stay flat, you're going to have north of $1 billion. Those contracted day rates, obviously, they're always below market because the charter has you over a barrel because they know you need the contract to get the debt to finance your ship. There's another 250 to 300 million if you just mark to spot right now on day rates. So it might be 550 of upside. So 750 all of a sudden is 1.2. Then you add the upside in dry bulk that people really like, especially in the Capesize trade. That might be another, we said 500 in the memo. The real number is a lot higher. So like you might have $2 billion of EBITDA. From a cash flow perspective, let's just do it on $1 billion of EBITDA. Her interest cost per year is about 150. She's got another $100 million a year of dry dock and special survey. She's selling some old ships, but let's just exclude those. That math, just the interest in the dry dock CapEx, that gets you to 750 of free cash flow. And she can only buy back because of liquidity issues in the stock. The stock trades about $10 million a day, 252 trading days a year. Say she's 5% of the volume. That's 125 million of buyback. So now you're sitting here and you're like, she's going to pay down $500-600 million of debt. So you're going to naturally just keep delevering. NAV's going to go up to north of $200. And we're like, I don't know. The question I keep asking people, because they're like, well, she's bad. She screwed people in the restructuring. I'm like, first of all, she's trading. The stock could double and it would still be cheap. Okay. This thing should be trading, I think a lot closer to like in line with the comps. I mean, I argue it should be a premium. It's diversified exposure. And like, while the shipping guys like, pure plays, generalist money, which is what takes shipping stocks really to the moon when the generalist guys come in, they're going to like, this is a multi-billion-dollar shipping conglomerate, a lot of exposure. You still have upside, but you're not going to get killed. You call one out of the three of her segments right, you return more than your stock price back. 2 out of 3 with the third one going to 0, and you more than double your money. And like, this is like baked in contracted cash flow. And so I just think every quarter, I don't know when the NAV gap's going to close, but I think this is way more interesting than first I had it, because it's not really an IDR play. She's doing building value long term. And eventually when she like quote unquote turns on the dividend, if she wants to in 28, 29, 30, she might then be paying out 30, 35 bucks a share pretty sustainably with probably the youngest fleet. So all this is to say, look, we had a nice jump on Q2 earnings. Stock ripped. It's sort of consolidating here. We've got November earnings coming up. I think it's going to be more of the same. I think every quarter more people are going to say, you know, this thing, like, it jumps off the comp page. Only 2 guys cover this. And like the Fernley guy we put in the update memo is just like ridiculous. Like he has 600 million bucks of EBITDA in 2 years. It's like, okay, like with the new builds, it's just mathematically wrong. I just think more people show up. I just, if this thing's still at 50 when NAV's over 200, like really, we're going to be at 0.25 times NAV. Well, she's like it just doesn't, like, things like this don't stay that way forever. And I mean, she's doing all the right things. I think the discount goes away. And I think it's just going to be a great home. I'm obviously super bullish on the thing.
Yeah, no, it's something I was looking at first. I started buying shares, I think like 40 something, 47. And I was like looking at the options chain, and there was nothing for January 26th. I was like, that's unfortunate. And then I looked again, I don't know, like 2 or 3 weeks ago. I was like, okay, there we go. Just take as far out of the money as possible. Cause like even at 75, that's still what, like half of the 150 NAV. And it's like, what, $3 or $4 right now. So I think the leaps are pretty interesting. If
I think the leaps are super interesting, and like, look, let me make the extra disclaimer right now so people don't freak out, which is we're about to talk about options on a shipping company. Like, this is not suitable for you. Don't do it. But I'm going to talk about the options.
But if it works out, it's going to work out really well.
It's going to work out really well. But there's an other point with the options that I want to touch first, and then we can get into the options just on a standalone basis. The stock liquidity has been an issue. Okay, so 3 people own her and the top 2 shareholders. One is like a sharp private fund, and the other is a 1980s vintage LBO baron, who's like a 70-year-old guy who wrote a very angry letter. He's richer than I'm ever going to be. And his call was right. He basically was like, I bought this thing in 2022, and like it was trading disgustingly cheap to NAV. Sell ships, buy back stock. So those guys have 40% of it. So it's like the market cap's 1.5, but it's really like the available market cap for trading is, you know, only 60% of that. So you're talking like an $800 million float maybe. And that's why this thing, and like people, this is stocks that start to inflect that are like left for dead. Like people who own it really like it and they ain't selling. So this thing trades 10 million bucks a day. The options are actually more liquid. Like the first 2 funds I worked at ran, you know, about 20 billion each. And they tell me like, hey, if we can't put on a $50 million position, like get out of here. And if you're going to do a 25, like it better be a 5-ball. Not in those exact words about 5-ball. Those guys don't talk that way, but super smart guys. But the options, I think a few things that stick out is, one, you can actually get a lot of exposure via the options, and you can thank, you know, the Susquehannas of the world, the Jane Streets, the Pod Shop guys who also own a market maker that I'm not going to use their name because why would I? But everybody knows who they are. But you can get a lot of liquidity through the options. The other thing I would point out, and I'm just going to start about the gamma, I think it's gamma squeeze, which is if the stock goes above certain strike prices, you look at the volume of options, the amount of option open interest, and what can happen. So looking at the September, I'm just going to isolate $60 a share for a second. You can look at the September 20s, which are coming up, the Jan 25s, and then the Jan 26s. At 60 strike, the Septembers, there's 2,700 contracts outstanding. So 270,000 shares. That's more than 1 day volume. If you look at the Jan 25s, there's 3,700 contracts. So almost 2x daily volume at 60. And at 65, there's another 4,500. Then you go to the 2026s, and and it's a little bit less liquid out there. The big, that's less. I guess it's really more just the 25s. And if you go up, going a little bit wider on the 25s at, actually, it's just, there we go. Oh yeah, at 65 and 70 on the Jan 25s. There's 4,500, then there's another 3,800. So the gamma on all these things, I mean, these things, the delta on the 70s right now, the Jan 25 70s is 0.1 shares. So just think about, like, if the stock rips to like 65, the delta is going to go up to 0.7. You're going to have like natural demand at 65 if it happened tomorrow. You're going to have an incremental, just from option hedging, 500,000 to 600,000 shares of hedging demand, which is going to just yo-yo this stock a lot higher. And I think that's like a super interesting thing beyond the obvious, which is what you're doing. And I own some of the elongated twos, which is, I look at the vol and it's like mid 30s vol. And I'm painting a picture that this thing can like multi-bag, obviously. I just think you're really not paying much for the options. I think I think the vol should be a lot higher given the convexity of the trade.
Yeah, I mean, the way I kind of look at it is like, if this thing gets going, there's going to be people chasing it, and if you think it ends up somewhere close to in line with other shipping companies, then it's like, all right, well, do I give it a year and a half for this option to play out? And if it goes to in line, then like that 75 strike goes from like basically a 50% move to like way in the money in a year and change.
So you're in the 2026 75s.
Yeah, just a small,
so those
small
are
chunk.
Yeah, so those are 35, and if the stock goes to 100, yeah, it's 20. Wow, yeah. There's just a ton of, like, it's really fascinating. I mean, the vol on that is 38 vol. That's the 0.3 delta. It's a fascinating story because it's like, it's also, we're doing this in the September 11th, like for people listening later, like oil is off $10 in 2 weeks.
Yeah, getting blown out.
Stocks are holding up fine. Iron ore is in an all-time low, and well, not all-time, like a 2-year low. And Vale just announced a production increase. And I think this is all part of the bigger shipping thesis. And this was kind of our Tidewater thesis from 2 years ago, and we can use this to sort of merge into OSVs and offshore. But I've been an energy guy my whole career. I have never seen a cycle where the order book is, what I would call effectively zero. Usually what happens is you have a 30 to 40% order book at the peak of the cycle. You go through a depressed period because of recession or whatnot. Through the recession, you have what's called the cascade. The cascade is the new boats hit the water. Your 30, 40% order book hits the water. People are like, we're oversupplied. I don't care that you're new. I'm going to give you a much lower day rate. That lower day rate on the brand new best spec, highest eco, scrubber, ship, whatever, means that the day rates on everything else have to go a lot lower. And eventually you hit this point in the cascade where the 15, 20, 25-year-old ships say, I should just scrap my vessel. And then eventually you normalize because the 30, 40% over, you have let's say a 40% order book when you did it and you were undersupplied, or say you were neutral. Okay. A recession happens, demand goes down. So now you have another 10, 15% latent capacity. And so to get the thing back in equilibrium for day rates to rise again, you need to scrap, 20, 30% of the fleet, or demand needs to increase a bunch. What we're going to see now, eventually, I mean, maybe this is the recession, maybe we're going in right now, but why we're not seeing day rates move the way that you would expect, especially the 1 year, 2 year, 5 year time charters. And Transocean just announced I think they undersold themselves. Their best rig they announced yesterday. This is an ultra deep water rig. They just signed a 1 year contract in 2028 at $635 a day, which is up from current rates. It's 2028. Like, I thought they should be getting 700,000-800,000 a day, but like, rates aren't down. I guess that's the point. And in shipping, you're still seeing rates hold up incredibly well, even with China in the dumps, even with global economic malaise. Like, you're still seeing ton mile growth increase and day rates hold up really well. All of this is because there's no order book. Back to Navios, why we talk about everybody else is giving up the game. She is effectively boxing out everybody by seizing all this new build. And that's what one of the things we love about this, which is everybody can't new build. It's a prisoner's dilemma, right? Because the more you do it. So being first and boxing out and getting those opportunities is pretty awesome. And then also back to Navios, I'd say the last thing when people ask me about spot exposure, and this is one last, parting shot, of their $1 billion of EBITDA, I think 70% of it is going to be long-term contracted. So you think about like the downside in recession, like that $1 billion, because she's got so many containers and product tankers, which operate on much long-term contracts, that $1 billion can really only be maybe 800, 850. Like it's super cheap on that contracted side. And that just all goes to like, we don't have a lot of supply, demand can come off, but like, you're just going to set yourself up for more upside, which is why, switching gears a little bit again, like why we're seeing Capesize. I know it's a seasonal rally, but like there just aren't a lot of ships. And that's why I think this whole space is pretty interesting. So, and one of those is obviously offshore, and we can, if you're ready to transition there, happy to go.
No, it's been an interesting ride over the last couple months in the offshore space. But maybe before we kind of do that, there was a kind of geopolitical show I was listening to, and they were focused on China. And one of the things they said is that China has something like 230 times the shipbuilding capacity of the U.S., and that Shanghai has more capacity alone than all of the U.S. So I'd be curious to hear if you have any thoughts on kind of the shipbuilding sector in general. Is that something we see come back to the States at all, or is it something that's going to be a huge constraint moving forward for something like Navios, for offshore, kind of the whole anything that requires a shipbuilder?
It's not coming back to the United States. If it wasn't for the Jones Act, which is, I think it's a 1920s or 1930s rule that if you go from U.S. port to U.S. port, you have to be a U.S. built and U.S. flagged ship. And the idea of the Jones Act was we have to maintain shipbuilding capacity in the United States, because if we go to war, who will build our Navy? The cost of the Jones Act, where it really impacts shipping, is like for ships to Puerto Rico from the United States, that has to be a Jones Act ship. From Hawaiian Islands versus each other, if you take a cruise ship in Hawaii, that has to be a U.S. flag cruise ship to go between Hawaiian Islands. Shipping oil from Houston up to the Northeast United States, or refined products, whatnot, that's 2 U.S. ports. That has to be a U.S. flagged ship. Now, when there's like a hurricane or something like that, they give a Jones Act waiver, which is like giving the ball game away, that like, obviously this doesn't fucking matter. Sorry, this doesn't matter. We'll edit that.
No, you can air it out as much as you want. So,
but in normal times, the Northeast United States gets refined products from Europe, actually, because of the Jones Act inefficiency. So the cost of the Jones Act to the U.S. taxpayer, the last estimate I've seen that may be dated, is about $300,000 per taxpayer per job is what. And so we build ships in Philadelphia mostly, and it is a very protected industry, and also in Virginia, right next to the Naval Yard. But the cost, I think on an OSV, we're still, a bunch of the Gulf of Mexico ones, Tidewater. Tidewater has a few. Hornbeck has more Jones Act qualified. That's where it really touches offshore. Those ships are 30 to 40% more expensive. Like, you don't want to build ships in the United States if you don't have to. And you're just it's low spec industrial stuff, have a deep harbor, a cheap labor force. It's great for jobs. Okay. So shipping left the United States, it went to Japan, it went to Korea, went to China, Vietnam, Indonesia, India, all these places. That's who built ships. For China, this is a real issue. And for Korea, it was too. So Korea lost, I think 300,000 people went unemployed in Korea from working at shipyards from 2014 to 2020, which is just devastating politically. China, very similar numbers. We have lost since 2014, I believe, 60% of shipbuilding capacity. And this is one of those bull stories about this. We talked about supply a little bit. So there's this real societal issue now, and this sensitivity in Korea, Japan, and China about, we're not going to restart a yard, hire 100,000 people, and then only let them be laid off effectively. Like, we're not doing that, period. So shipbuilding capacity came way in. The shipyards themselves also got a lot less aggressive in terms of what they would do to help shipbuilding. So before 2014, you could get a ship built with 10% down, and the shipyard would give you export bank financing for the rest. Now you're 60% down, 40% financed, and your 60 comes first. And time to build went from, less than 2 years to, 3 to 4 years. The shipyards also, having gone broke and realizing all this stuff, basically said to the offshore guys specifically, look, we've got LNG tankers that we're building. Those are on long-term contracts. We've got containers that we're building also on long-term contracts. Like, we don't want offshore. All you guys went bankrupted us and all this other stuff. Like, we're not doing it unless you put down a bunch of money. And oh, by the way, it's going to take 5 years now to get a deep water rig, not 2. And we're sold out until 2026 anyway. We can't even start your boat or your rig until then. So I think from here, like, it's great for the supply story. And going back to Angeliki and Navios, like, she sees the available new build capacity. Like, if you want a Cape, like, you're not getting it until 2030. And, the cost of that is also going to go up a lot too, because slots are limited, unless you literally restart a yard. And we'll get to restarting a yard in a second. If you don't restart a yard, the existing yards are going to tell you, hey, my capacity is finite. If I build a Cape for you, which is, $65 million for a new one, 20% margin, I only make 12, 13, 14 million bucks. I could use that same manpower and that berth, that ship capacity, to build a $200 million LNG tanker or an FPSO or whatnot. You have to give me way more dollar. I need to stay dollar margin equivalent, because those guys have me filled up anyway. So I think you're going to see the cost of new build for ships, OSVs, what have you, and rigs keep going up because of this dynamic of the ships, the shipyards being sold out. Now for China, look, if you get enough demand, you could show up and you could get them to restart a yard. But what that's going to take is you're going to have to be like, here's all the money. I have all the money up front. Here's my 5-10 year contract on all these ships. Here's my financing. Like, you're going to have to show up with 50 ships, like, in order for that. And I find that to be a very difficult argument. Like,
yeah, that's a heavy lift to get that amount of size.
Yeah, and like, let's take for Capes, let's like take the extreme, right? Because Capes have about a 6% order book. There's 2,000 Capes outstanding. A bunch of those, by the way, are 20 years old. Vale, BHP, and all those guys don't like shipping iron ore on north of 20-year-old ships to begin with. But say you show up with that order for 50 ships, right? So 50 times, call it, 75, 80 million bucks. So let's call it a $400 million order. Like, no, it's not. It's $4 billion.
$4 billion. Yeah.
Like, $4 billion for 50 boats. Like, am I doing that math? Now I got to check that math. Okay, hold on. 50 times 80. Yeah, $4 billion. All right. I passed AP calculus. All right. My teacher's horrified, but the total market cap of dry bulk is under $10 billion. Like, who is making this order? And this is the same thing that we talked about with ultra deep water rigs, when people are like, things are going to come online. The fleet's 185 rigs. I was like, dude, a rig costs $1.5 billion to build. Who's like, all right, build 10 of them. That's $15 billion. Like, Val, Rig, Noble, that combined market cap is nothing. And it's not even close to 15 billion. Like, who is making these orders? And even if they do, like, fine, it's 10 rigs on 185. Like, it doesn't matter.
And where do you need day rates to go to, like, make that make sense for
these guys? And it's like, and these guys are going to show up, and like, the yards are going to be like, you don't have the money. You're going to need BP, Shell. Exxon's going to have to provide a backstop to it. Then they're going to get in a fight with the rig guy. They're like, well, if we're giving a guarantee, like, I want a discount. The math just doesn't work, And now, like, look, this is an easy argument now with oil collapsing. Like, nobody is ordering, okay? Like, and you're, in fact, in shipping, that's, in ultra deep water, obviously there's a bull cycle, and we can debate this. There is just a few people ordering OSVs that compete with Tidewater, but, like, not a lot. Maybe there's 100, 150 versus a fleet of 2,500. But, like, in shipping, like, yeah, we're getting product tankers. I mean, I think the worst order book is Aframax LR2s at 15%, but, like, you also have, I think it's 18, 19% are over 20 years old. But the idea that you're going to have runaway new building, like you saw in 6, 7, 8, in 2012, 13, 14 and get to a 40% order book. Like, it's fantasy. Those guys in those cycles had to put down 10% equity, and you're just not seeing that. And so if the fleets don't grow, day rates are going to stay elevated. We've already broken away from the levels that we were at, which is basically marginal cost plus a little bit of margin. We're already at the point where guys are like, I guess I just got to pay what I got to pay. I mean, if you want to dream, the Capesize day rates peaked at almost 200,000 a day. I mean, they're at 27 right now. It's because shipping,
that's some interesting math for a company like Navios.
It's great. Like, look, are we going to like? I think we put this in the update memo, like the Dalman Rose piece from like the literal peak when day rates were there, and like I think the one thing that like we pointed out was we're like, look, I think it's from 2022 to or 2002 to 2006, Capesize day rates were like 50,000-60,000 a day. If they go to 40, Navios makes 500 million more in EBITDA. Like, if you really get a Cape cycle, like, I mean, first off, all these things are buys, not just Navios, but like, and that's the other thing. And I think for his offshore, you know, look, Tidewater's come back a lot. It's mid-60s now, so that's like relatively value attractive. I mean, when we started putting on Navios, Tidewater was like 90 to 100, and we were like, we think 200. I think 200 through the cycle is the number for Tidewater. I mean, with Navios, I'm like, I have 3 segments. I'm saying 200, 250, but like it's gonna be 500. Like, it's just a monster number. It's a much more durable story that's like much more diversified in terms of like the ways that you can play it. You know, you've got product tankers, you got containers, you got dry. Like, you're just through the cycle and like the ups and downs economically. I just think you're going to end up like much better in Navios first. I mean, Tidewater at 65 is pretty juicy. Like,
yeah. No, it's interesting because you see all this stuff get smoked over the last couple months, and like I kind of argued in one of the things I wrote that Secor is arguably cheaper than Tidewater, at least on a per boat basis. But I think one of the things I was seeing, either it was you or one of the other guys on Twitter talking about was it the Hornbeck IPO and the potential for Tidewater to refinance, do buybacks, and potentially acquire. Yeah. So I'd be curious to hear what you think that looks like for Tidewater maybe in the next year or two.
I think I mean, they have to be talking to Hornbeck. I mean, Hornbeck is owned by distressed debt guys. Ares owns 40% of it. The Minnesota Mafia hedge funds own another 25%. I like saying Minnesota Mafia since I'm from Minnesota. All those guys are super sharp. They spun out of, the fund spun out of Cargill's desk. So it's like Whitebox, EBF, which is now Merced, Wyzetta. I mean, all those guys are so sharp. Oh man, they're killers. But you've got like 4 or 5 distressed guys own Hornbeck, and you're sitting here now. Like, you try to do an IPO, they got screwed. They have a small Mexican business that they got screwed over by like Mexican nationalization. They're through that now. The thing's growing again. They just had to reposition the ships. But you have a distressed owned IPO where, like, if you list the thing, people are like, all you guys are selling. It's like worse than a private equity overhang because you're going to be, there's 5 of you that are going to be dumping randomly as opposed to one private equity guy that's going to at least be a little bit more tactical about it. Tidewater's come in a bunch too. So it's like, what's the demand level? And so these guys are sitting there with a subscale business, likely a stock that's going to come at a big discount. Can Tidewater just swoop in and be like, we'll give you 15 million in OSV, new builds, 60, 65, like, we'll give you 25% of replacement costs, some equity. You can roll into a much more liquid vehicle. We get scale, blah, 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 blah. Like, this is a way better trade for you. If they, I'm really hopeful they can make that math work. I mean, so we'll see.
Yeah. Do you have any thoughts on Secor and what that looks like? I mean, obviously it's not going to work with oil doing what's been doing over the last
less
couple
liquid,
weeks, but
look, Tidewater trades 70, 80 million bucks a day. It's the same exposure. It's the best management team. It's a great fleet. Secor, it's like one of their segments is OSVs, and they got a bunch of segments that are a bunch of small stuff. Look, if OSVs really moon, will the crappier, less liquid thing potentially outperform the bigger, more liquid name? Yes, but you can say that about a million things.
Yeah.
I don't think that's comparable at all.
Okay. I mean, while we're kind of talking about offshore, I think one of the things that is interesting when you're talking about order book, it kind of went back to the jackups on Bor's recent conference call. I think they said something like 30% of the world's jackup fleet is like over 30 years old. And with the day rates, there's been a pretty interesting gap between like younger premium jackups and older ones. I'd be curious to hear your thoughts on bore drilling, because I mean, I look at the results and it's basically the stair step up and to the right with revenue, and like they did the refinancing dividend. I'm hoping to see some buybacks, but we'll have to wait and see on that. But they got the two new builds coming in the next, I think one just got delivered, one's in 3 or 4 months, but I have a hard time seeing how that doesn't work pretty well over the next year and change. So I'd be curious to hear your thoughts on Bore.
I like Bore. I don't own it. Look, the spread, the oldest, lowest spec, crappiest jackups in the world are all in the Middle East. I mean, I think it's ADNOC Drilling. It's got like 200 of these like crappy 1960s platforms. A bunch of these things are also in the
I think Shelf too, right?
Yeah, and Shelf Drilling. Well, Shelf isn't like, I mean, what's Shelf? 5 rigs or 6 rigs? I mean, it's not.
No, I thought they have a whole bunch of them, but their average age is like 34, 35 years, right?
Maybe it's the deep water ones, the Shelf. Anyway, it's not big, but like, yeah, like these things are, it's not comparable at all for some like a super high spec jackup like Bore's got, and Val's got a few of them, and Annie's got a few of them. Look, 50% of jackup demand, or 50% of the jackups in the world are in the Persian Gulf, in the Middle East. So that's the trade you're making. Obviously, the Saudis have been like cutting fields, raising production, blah, blah, blah. I think, look, on a 5-year basis or 4-year basis or 3-year basis, if you close your eyes, you're going to make a lot of money on Bore. Seems likely. You know, they do have a big Mexican business, which is a little bit of a new lot too, given what sort of happened with Hornbeck and what's going on there. So there's some hair there. There's some leverage, but like it's not hard, especially with the leverage, to see like, wow, what happens here. It's certainly a curiosity for me. I think it pencils out really well. I just find Tidewater to be cleaner. I found Navios to be cleaner, but they
do only have two jackups in the Middle East right now. Like,
they moved them, but the Mexican ones are also an issue. But like, it doesn't matter where they actually have theirs. With 50% of jackup demand being in the Middle East, what if the Saudis wake up?
That sets the day rates.
Yeah, everywhere, and then the North Sea's a mess. So it's like, we started this thing talking about Sable Offshore and hair. Like, I think the problem you have if you try to pitch Bore, like it's not that liquid, super levered, and then like every region you're like, well, there's bad news in Saudi. They've been cutting. Well, the Northeast kind of the North Sea kind of matters. And, they may ban drilling with this new socialist government. They got a lot of stuff in Mexico, and they just nationalized some other people. Maybe they'll nationalize us. Like that, it's too much complexity right now. And certainly, look, it doesn't even matter because with ultra deep water, the core ultra deep water stocks, Rig, Val, NE, selling off 30 to 40%. Like nothing's going to work. It's not. But like from here, I agree completely with the idea. Like, what would I buy? Like, I would buy if you tell me I have to buy an offshore focused stock, I'm buying Tidewater first. If I have to buy another one, I'm probably buying Bore or Val.
Or Val warrants. No,
I don't know if I need to buy the warrant. Like the warrants, it's like, mathematically, sure, you can do it. Like the math, I think it's 2028. It's a long time to 2028.
Yeah.
And certainly, like, look, if you're long the warrants, you're kind of happy the stock came in a bunch because then they can buy back more here, and then you can get that leverage. I think the thing with Val versus Rig is, when we started looking at offshore again in 21, we put the Tidewater memo out at the end of 22. Like, Rig is valued so much higher than the other ones, or it was, one, because of the debt load, 2, because it didn't file for bankruptcy, and it was just way more liquid. And we were like expecting that premium to really dissipate over time, and leadership just transitioned to Val and NE, which has kind of happened, but like in the way you didn't want, because they all went down and you just like did better. But like at this point in the cycle, like Val and NE are relatively unlevered. And I think it really, your value really becomes, what am I paying per ultra deep water rig? And like my math's a little bit dated. I mean, it's definitely lower now, but like you were paying like north of 400 a deep water rig for Rig and under like 250 for Val. Those numbers are probably like 200 now and 350. You also saw over the last couple of months, Rig, a lot of their, they said they had 37 rigs and floaters and whatever, like a bunch of those are garbage and are never going back on the water. And they sold off a bunch of them. So I think that the shine's come off rig a lot for people. We sort of thought you needed to see a clear move on day rates. I think the whole sector's moved down because we started pausing day rates about a year ago. Now they've all contracted out through 26, 27. So even if you get day rates moving, I think the heartburn versus Tidewater and why we like Tidewater versus the rigs is the contract cycle is way shorter in Tidewater. So in an up cycle, you want that 6-7 month average contract duration with Tidewater because the gap between what you're actually earning and spot rates stays a lot tighter. With the offshore guys, say you wake up tomorrow and you're like, day rates went to 700. Are the stocks going to go up? Yes, but you're not going to get to eat that 700 in earnings because they're basically all contracted through 26.
Yeah, they're all locked in.
Like that's 2028. And, you may not fully contract. Are you going to contract now for 2028? No, you're going to wait. Like, so you're just going to trade at this much bigger discount. And I think people overvalued sort of the asset quality, if you will, of ultra deep water rigs. Like, hey, I'm buying $1.5 billion replacement cost, whereas OSVs used to be $30 million boats. Now they're 65. Like, that's just a smaller, crappier asset. It'll trade at a discount. And what we've seen is like people are going to pay up for day rate momentum, and that's what you get in OSVs. Tidewater also separately. They're at the Pareto. Everybody's at the Pareto conference right now. Tidewater, I've heard, sounds pretty bullish.
Yeah, I think the other thing too with Transocean is you see kind of the continued dilution, which is frustrating for sure. But with Valaris, like you look at their, like they have a bunch of their contracts set to expire between now and like the end of 25. So I'd be curious to see if that kind of kicks the buyback into high gear. I don't know if you have any thoughts there.
I don't know. I mean,
they should be buying back right now. Like,
yeah, but like their open EBITDA at 450 a day was it 1.8 billion, and I think they're actually doing. Let's pull up street numbers. Like 500. Hold on. Let's pull this up. I should know this. I think it's $1 billion next year. Okay. So it's Val. For 24, they're going to do 500 of EBITDA. 25, they do 850, and then 26, they do 1.25 billion.
Yeah, it'll be interesting to see how that plays out. But are there any other sectors that you're kind of looking at right now as far as next ideas or things that you think look interesting over the next couple of years?
I mean, we look at everything. So I don't just do energy. I mean, we're people love talking energy and commodities and all that other stuff. We've got memos out on a bunch of other things. We own this AIoT, which was a really interesting event-driven trade, a merger between Mixed T and Legacy Powerfleet. Pretty bullish on that. We like to cover sort of everything. I'd say energy is a big part of my book, but I've been in event-driven capital markets type stuff for almost 20 years now. So looking for things that grow and compound. I mean, energy I left for almost a decade and got to come back. I thought energy was going to be dead forever. Most people did too. The stock certainly reflected it.
Yeah. No, it'll be interesting to see because I'm kind of in the commodity super cycle camp longer term. Obviously, that markets aren't reflecting that over the last month and change. But I mean, you look at something like gold to oil ratio, basically plumbing all-time lows. Like, I don't know how you're going to have gold hitting 3,000 with oil staying between 60, 70, 80, but it'll be interesting to see how that kind of.
I mean, that's way too fancy for me. I don't know. This gold oil stuff, all this macro stuff is like way over my pay grade.
Yeah. I mean, if you take out the negative oil spike in COVID, it's basically at all-time lows, or at least lows for the last 40 years.
In dollar terms, this is the crazy thing about energy. Like the economy was fine at $100 oil for like multiple years leading up to 2007, 2008. Like back to Capesize day rates, they were like 50, 60,000 a day for years. And it was fine. And I think the thing with, the point that we made at first on Tidewater, and now we've made sort of on Navios, and really both of those were calls on the sector too, is everybody who remembers what the good times really were is retired, dead, or, I don't mean to be morbid, but like they're not here anymore. And, if you've been in this business for just a decade, which is a lot of time, like all you know is this sector stinks. And these things trade at literally like day rates are at OPEX plus like a small margin. Like, come on. And things can turn. Like we talked a lot about the shipyard capacity. That's kind of the story, which is, dry bulk, going back to that, like ton mile growth is really, you have GDP growth globally of like 2 to 3%. Ton mile growth because of the industrialization, meaning like demand for natural resources, carbon-based fuels or iron ore in the case of Capesize, that grows higher than GDP as, you take an agrarian wood-burning society and it industrializes. So you have ton mile growth of, call it 5% a year in dry bulk. Container ton mile growth is 8 to 10%. And, crude oil, VLCCs is the worst one. And that still grows maybe 1%, 2% a year. So you got growth. And if you're not adding ships and the old ships are getting old and have to be scrapped, like rates go up. It's kind of like, that's kind of it. Like if you own an existing fleet, you want new build to like go as high as possible to keep supply as low as possible. Because all shipping is effectively, it's a regressive tax on the economy because you're a middleman. And you're only, for oil, it's like the math is crazy. Like you can ship oil from the Middle East to the United States for under $1 a barrel. Double rates, great, $2 a barrel. Well, now with oil, it's 65. That actually matters. But like, it's not a big, like these day rates can go up a ton. I mean, it won't be felt in the economy at all because you're a small piece of a much bigger pie. And that's why day rates were sustainably higher for a long period of time. And we think they can go again. And if they do, these things are all going to pay out a ton of cash flow. And hopefully, I'd say I retire in Miami, but I already live in Miami and I already feel retired. So
yeah. Well, I think that's a pretty good wrap on all the stuff I wanted to cover. But I did want to ask my traditional closing question, which is, what book do you think I should add to my reading list? Can be investments, history, finance, anything you think would be interesting.
Wow. Have you read Oh man, I got to find it. The shipping book. Hold on. The Forgotten Billionaire. Here we go. Hold on. The Invisible Billionaire. There it is. Oh, wait. There we go. The Invisible Billionaire by Daniel Ludwig, or about Daniel Ludwig.
Okay.
When I did the DHT deal, the shipbroker showed me the deal. This was like the deal toy he gave me. If you can find it, there's a really good podcast about it on the Founders Podcast. So
I think I might listen to that one, but I'll have to go back and check.
It's an awesome book. I mean, this guy, what a legend. So
yeah, well, I think I'll have to check that one out for sure. So I think that's where we'll be wrapping up. Thanks for stopping by, and we'll see you next time.